Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at the US markets. We're also going to be looking at the PCC, put the call ratio, and the VIX. So we're going to start here with the SPY, which is our proxy for the S&P 500, and we're going to come over and have a look at the Nasdaq in a little while as well. We're going to start with our Elliott wave count first, and then we're going to spend probably more time on the classical analysis, to be honest, as I honestly feel, given the price nature at the moment, it probably offers more than the Elliott wave does at the moment in terms of because of the kind of structure we're dealing with here. So I'm suggesting that after peaking in January 2022, start of this year, we've had a single zigzag down to here, we've had an adjoining flat pattern for an X wave, and we are now in a secondary zigzag which will drive price significantly lower and more aggressively than the first zigzag. However, there is also an alternate count in here within the primary which is that the zigzag's already complete, and we can move the Y to here. So the Y and the 2 up to here and say that we're done. Now there is some evidence for that in the classical analysis, however there's also some evidence to the contrary, and it's just one of those things at the moment where we're just going to have to wait and see how things develop. Okay, so now we have an alternate count which can also accommodate this, which is a diagonal, which is an A, B, C with a diagonal in the A. I'm calling the thing a diagonal pattern. The thing itself is not a diagonal pattern. I just remind myself that it's different from the double zigzag because it has a diagonal in the A, so that's why I've labelled it diagonal, though it itself is a zigzag. A, B, C with 5 wave impulse in the C having completed already, and now on the move higher. That's an alternative view of looking at it. If we take a 1-to-1 measurement, you can see that we come to the 123.6, we go a little beyond parity. If we come back and have a look at the primary count for a moment, and we have a look at this internal ABC on the orange count here, you can see that we get a 1-to-1 and a bounce here. So that could be the W, and it would have completed the function of a double zigzag. But the function of a double zigzag is to drive price deeper. Okay, so this is your first zigzag, your W, and this is your secondary zigzag, your Y. Okay, and it's joined by an X wave here, another 3-wave structure, which in this case I've drawn as a zigzag, but it could be any correctly structure. It could be a triangle between the two, for example, but in this case we have a flat, an expanded flat for our X wave between our 2 zigzags, which are either here or a much deeper one to come. Okay, now why would it be so much deeper? Well, all I've done is worked on the basis of this either being 1, 2, 3, 4, 5 into an A, and therefore I'm projecting parity for the C, and that brings us down into either the 50% retracement zone or the 61.8% retracement down here at 349 spot 46 and 318 spot 23. Very likely and typical Fibonacci targets. I know the 50 is not a Fibonacci number, but it's a typical target, 50% retracement. And then we've got 61.8 down here, which is the golden ratio. So if that's going to be our A, then it stands to reason that that will be our C, joined like that. Okay, or it's complete. That's the alternative. Whether we've done that dodgy diagonal, which does not look very pretty here, the diagonal in the A, I mean, which does not look very pretty in the SPY. It looks a lot better in the Nasdaq, however. So let's come over and have a quick look at the Nasdaq, where we have our diagonal count here already on display with the diagonal A. It's still a zigzag, ABC, with a diagonal in the A, 5 waves down, and contracting wedge pattern, 5 finishing below the 3, 4 is smaller than the 2, the 3 is smaller than the 1, and 5 is smaller than the 3. Exactly what you'd expect to see in a contracting and leading diagonal in this case, although it does subdivide as 3, 3, 3, 3, 3, 3, 3, which a leading diagonal can, but we would always see in an ending diagonal. So we then have a 5-wave move down here into a C to complete a 2 at the 50% retracement right here. So we've given up 50% of the move up from the March 2020 lows. The market's retraced 50% of that move, which overall, as an actual percentage of the total value of the market, is roughly a 30% retracement, a 30% price reduction, sorry, and a 50% retracement of the prior move from the March 2020 lows. So it's a significant chunk that the Nasdaq's given back, more so than the SPY, but things could still progress negatively. The primary count still suggests that this was just an A down here, okay, and that the 2 is lower, perhaps beyond the 50, perhaps beyond the 61.8, perhaps a deeper retracement for a wave 2 here in the Nasdaq could be on the cards. Okay, so they are the 2 counts. I'm just going to label this one because I keep referring to it and I shouldn't. I should just call it a zigzag, but I'm just going to call it the alternate. I keep reminding myself that we have a diagonal A and an impulse in the C for a zigzag here. Now if we take the length of the A, project it from the B, you can see that we get roughly just beyond the 1-to-1 parity, which is typical for a zigzag, and then we bounce at that 50% retracement level. Now that's really all I've got for you from an Elliott wave point of view. So what I want to do now is just turn off the count, and we're going to have a look at some other things here as well, which may give us some clues. And we're going to start by keeping things absolutely basic to begin with. So first thing I want to point out, let's bring up our volume, our moving averages, and our VPVR as well. Okay, just want to start out at the weekly time frame. So let's have a look at the SPY on the weekly time frame. Now we have, on the week of the 9th of May, we have an extremely bullish candle. Okay, it could be more extreme, it could have reversed and closed positively. You can see from the red close here in the volume that it was a negative close. We can see by the colour of the candlestick that it was a negative close. Okay, we closed lower than we started the week, but we have an extremely long wick to the downside. Now that wick to the downside is often a sign of reversal or potential reversal. Now if we come into look at the RSI and the MACD, we see no evidence at all on the weekly time frame of bullish divergence underlying any of this downward move. But we do have a very bullish candlestick nonetheless, and we have currently what is a weekly engulfing candle following it. Now we are currently Wednesday today, and we are looking at a relatively low volume week. An engulfing candle, if it closes higher than the previous week and gobbles up this small bit of price data we have and closes positively, then this will be a bullish engulfing candle, right? But at the moment it's not looking particularly convincing volume wise, and there's no bullish divergence. So this bullish candle does fit the idea of a reversal, but it could just be a reversal of an A into a B into a C. So now let's look at the daily time frame here, and we see a very typical thing that I always point to, which is when we get the 60 exponential moving average crossing over the 250 exponential moving average on the daily time frame, 90% plus of the time this is synonymous with a low forming. Now not necessarily a bottom, but it happens when the low's here. And we can see that we had the 60 cross over the 250, this is what people traditionally call a death cross, and that gives us this bullish candle here, okay, which once again we saw on the weekly time frame is very bullish. Okay, and then we've had a series of bullish candles since, and we're now back above the 10 exponential moving average on the weekly time frame. Now on the daily there was some, and I mean lightly, there was some bullish divergence between the low back here and the low at the bottom, or our current bottom. Alright, no sign at all of a low of bullish divergence in the MACD. We do have a buy signal. I know that some people don't like it being referred to as that, but that is what it is traditionally called. We have a signal crossing over the average and the green bar appearing on the histogram, following a bullish reversal signal in forms of a bullish candle. However, that does not mean buy, it simply means that momentum has shifted from negative and is now moving back towards positive. We're still well below the zero bound though, and moved back above the zero bound with RSI pushing back into overbought conditions, and strong price movement from here would look a lot more bullish, but we've got some way to go before we get that, and we might not get anywhere near that. We might roll over before completing that. So that's the next thing. We got our death cross, we got our low, we got some bullish divergence in the RSI on the day time frame, but nothing particularly convincing. We've had declining volume in this move up since. Now that is not unusual for a rally in the SPY here or in the Nasdaq. Okay, all the rallies occur on declining volume and all the sell-offs occur on increasing volume. Okay, so we don't have to see volume supporting the overall rally. It can decline the whole time, and that's what we've seen in these previous moves up. We've had declining volume during the rallies. Okay, where the initial move out of the low, the peak was around the sell-off, and then we decline as we rally. That seems to be the norm here. So we would still like to see a positive candle in terms of the daily or weekly time frame to its prior candle, supported by volume, suggesting that momentum is still with the upward move. But this often appears contradictory here in the US indices, where we just seem to climb on declining volume. So there you go. We got that bullish signal either way. We came to extremely oversold conditions. Well, not extremely, but we came from overbought to extreme, to oversold, I should say. We did what I call a round trip. All right. Now on the Nasdaq here, let's have a look at things and see if there's any difference over here. So now we can't bring up our volume profile here, and we can't bring up on balance volume or anything like that, but we can still bring up our RSI. We got this double bottom in oversold conditions. Right, so we didn't set a lower low in the RSI, but it isn't clearly bullish divergence, and there's no such bullish divergence between recent lows in the MACD. On the weekly time frame, we get another extremely bullish candle, huge bullish hammer, right, almost closed positive. If it had done, we would have had a positive reading for the day, and we got or the week, I should say, and we got this long wick to the downside. This is easily a hammer. Hammer is defined by the length of the wick below the closing of the body of the candle being at least double the width or double the size of the body of the candle, which you can see you could probably fit 5 of these bodies inside of this wick. So that's a very bullish candle, currently engulfing weekly bullish candle as well. And then if we come back into the daytime frame here, we can see that unlike the SPY, the 60 crossover to 250 a significant time ago, and only resulted in a temporary low before climbing and then falling again. Alright, but this is synonymous with the fact that we have corrected significantly deeper here in the Nasdaq than we have in the SPY. Now we still have that same bullish signal here in the MACD, where we've crossed over the signal through the average through the signal is now recording a green bar on the histogram, but we've got a long way back to the zero bound before we can claim to be back in positive territory. Momentum may have shifted more positively, but has yet to reach positive territory, so we're not trending higher at the moment. We would like to see price come back into overbought conditions, a bullish impulsive structure in our Elliott wave count, supported by momentum in positive territory, and then we could be certain, much more certain, that we're trending higher at that point. So very much up for grabs at the moment in terms of where it could go. I'm not particularly convinced by these lows. Okay. Now, however, I'm going to caveat that because I want to introduce one more indicator here. We're just going to bring on balance volume for a moment. And I want to show you how also, if we bring up the on balance volume here, we can see how there is no bullish divergence at the lows here in the SPY either. There wasn't any in the MACD on the daily time frame, and there was barely any in the RSI at these lows. Okay. Now, if we come back to the 2020 sell-off for a minute, where we have this green and yellow line on the chart, these verticals, these represent the VIX and the PCC readings reaching their extremes prior to the low, which is another way of linking all of these things up to try and find a low. Now, the on-balance volume bottomed on the low and showed no prior bullish divergence at all. So the traditional metric of looking for institutions to be buying into the dip or buying into the sell-off towards the end of it, this was not present. It only reversed at the lows. Now the MACD was the same, with a mild divergence between where the VIX peaked and where the PCC peaked, but once again the MACD reached its low at the actual daily low of the March 2020 sell-off. The only really strong clue that we were getting a reversal was the RSI, which was showing up very strong divergence of a series of higher lows as the sell-off became more and more extreme in price. We essentially hit the maximum amount of selling pressure we were going to do very early, which is all the way back here in the February, and the rest was done on essentially weaker RSI readings, although momentum still thrusted lower, and there was no sign of bullish divergence and on balance volume, but there was in the RSI. This is tricky to read because of the severity of the move down, having already created such an oversold condition. We couldn't really push much lower. So this was one of those kind of sneaky lows which didn't really, bar the RSI divergence, didn't really give us that many clues. We had the VIX and the PCC reach extreme levels, but that's, like I said, that can be a week out sometimes either side or more. Right. So coming back and comparing that to the current lows, it's not as severe, but it's not much clearer either. Okay, you see what I'm saying? No strong divergence in the RSI this time, no divergence in the MACD or in the unbalanced volume, so it's not a particularly convincing low, but it is a very convincing candle on the weekly, so there you go. Make of that what you will. I need to see a little bit more before I'm convinced that we've bottomed here, so I'm going to keep the negative, keep the primary, that we're going to come lower in another zigzag. Right, so let's now just go and revisit that before we come over and have a look at the PCC and the VIX. Now actually we'll do that first and then come back and refresh the count. So the PCC, using my 60 and 250 exponential moving averages to even out the price, I created this is a range I've used for a long time. This is what I call the extreme fear and panic line, and this is called the extreme greed complacency line. Now you can see we set new lows in the latter part of 2020, okay, and February 21, and then we started to drift higher, and we have done ever since. Okay, and we've recently approached the dashed line here, which is that we're entering fear and panic territory. We haven't come through the extreme fear and panic line yet. Now we've only done this a couple of occasions, back in 2015, 2011, and of course during the GFC. But what I've noticed is that there's a downward trend. Okay, each time we come back into this territory, we bump into this descending trend line. Now we're awfully close to it, awfully close. So this could be enough for the market to have reached a fair condition and to have put in a low, and then reverse and work our way back into, greed and complacency territory over the next couple of years. However, there's nothing stopping us from pushing higher, like we've seen extreme readings before. Okay, but we're approaching this trend line, and if that trend line holds, we could have another move down, and then we could start to head back. Okay, but the market, as we pointed out, with these green lines and yellow lines that we've looked at throughout the history of the SPY here, PCC being the yellows, yeah, there, and we've got another one back here somewhere, here, we can see that they're synonymous with marking the lows of the market. And we're very close to that same trend line which has previously marked other market lows. Right, so it shouldn't be ignored. Alright. And I'm not convinced sentiment is bearish enough yet. I mean, it might just be because I've been around for a bit too long and nothing rattles me anymore. But I know there are people out there panicking. You only got to go on YouTube and see all the great bear market, Great Depression 2.0 stuff. Once you start seeing that at fever pitch levels, and everyone is convinced that they're super clever, super smart because they figured out that the market's crashing and is never coming back, that's a sign that the low is imminent. Okay, that we're about to find the low. I'm not sure we're quite at those levels yet, but it could go either way. We need a bit more price data. The VIX has been extremely resilient considering a 30% sell-off and 20+% sell-off in the markets. I've got this big green box showing how that throughout the previous lows, which are marked by the green lines, right? These are peaks in the VIX which mark previous lows in the market. Okay, the vast majority of them tend to fall into this big green box here, with a couple of extremes being the end of the global economy, as it was during the GFC, where we entered a new monetary system, and a new fiscal system. Not publicly, we didn't announce it, but we totally 100% did. And then we have the COVID thing here between these two huge peaks, right? These are. We will look back in history eventually and say, well, these two moments were. This was the beginning of a new monetary system, or you could say the death of an old one, and life support, and then you could say that this was the next significant turning point, which brought in the next paradigm. Now, since then, we've popped our nose into this territory a few times, but we haven't had a real eruption in the VIX yet. Okay, so if we are going to go lower, we should push this VIX back up into this territory, perhaps even get another extreme reading, although I wouldn't expect it. These things are rare. Like, you know, so pushing back up into here, the PCC trend line coming down to meters, one more low on bullish divergence, RSI, MACD, and preferably on balance volume as well. If that could happen, and we get a higher VIX reading and a higher PCC reading, and we get all of those bullish conditions in our indicators that we spoke about between this low and the next one, that would look very, very convincing as a low. Okay, so that's basically how I see things at the moment. So if we just bring up the primary again, like I said, not convinced completely by this low. It is definitely a low. We've got the 60 over 250 cross. Okay, we've got that bullish candle, but it could just be the completion of an A, B before coming higher. Now, unfortunately, this is the sad thing about a zigzag, is the retracement of the B can come all the way up to, but not beyond, where the A began. And it can still technically be a zigzag. Right, so we won't know that this wasn't a zigzag until the previous high up here on the 29th of March gets taken out. However, Bs that deep are very rare. Okay, we don't tend to see a B form like that in a zigzag. A much more typical target would be a 50% to 78.6% retracement, with 78.6% being on the less probable range, being a very deep B. Okay, but coming back into anywhere between, actually I should really say 38.2 to 78.6, it is a pretty broad range. So what we can use is our STS setup for that. Okay, so 38.2 to 78.6, your B is going to come in somewhere in here. Alright, golden ratio, we've got some volume. Let's pull back on the chart a bit so we can get a bit more of a reading on the volume profile here and see what we're looking at. So between the 38.2 and the 50, we've got this peak in the volume profile here, and around the golden ratio and the 78.6, we've got this peak here. So anywhere in here, we could bump into resistance. We've already gone through a prior low. Sorry, we haven't come into a prior low, I should say, or these lows either. So we've got structural resistance ahead of us as well. So let's just mark that here. Your first point of resistance. I mean, you've got roughly an area. Let's take that low, and let's take the higher low here. So as you can see, between the 38.2 and the 50, in amongst this volume here, you've got a lot of resistance. So your B could form somewhere inside of this area here, and then you will come up in a free wave structure. This should form, okay, and then you'll come down in 5 to get that C. If we start to see an impulsive structure of 5 waves out of here, a clear 5 wave structure, we push up and through this territory here, and then we get into positive trending on our momentum indicators above the 0 band, and then we get an overbought reading, right, which we haven't had a proper one since November last year. If we come up here in 5, get a really powerful move, then it's probably far more likely that the market did bottom down here in this shorter ABC. Okay, so what I would say is we're closer to the lows than we were a month ago, if that's any help. We could even have them now, but the deeper we go, the closer we are, and everything is leaning towards that. So trading perspective, you're going to be looking for a 5 wave move on a smaller time frame, and 3 wave move back for a potential march higher as either ABC within a zigzag within a B, or potentially 1, 2, 3, 4 higher. From an investing point of view, if you're a long-term believer in the United States economy and you're a long-term believer in these indices marching higher, you've already had a pretty significant discount, and there are signs of strength forming here near the lows. It's not the most convincing, but if you're a long-term accumulator, better to buy here than buy at the highs. You know, so that's it, guys. That's all I've really got for you this week. So we'll wait and see how things develop here now. Do we come out of here in 5? Do we come out of here in 3? Okay. Do we march and break these resistance levels? Do we come back through the 50, through the 61.8? Do we continue to trend higher? Do we gain positive momentum? And all these other things as well. In which case I think we can probably become significantly more bullish. But it's still got some way to go before I'm convinced yet. Okay, so That's it, guys. We'll leave it there. Thank you very much for joining me on the technical analysis of the SPY, the Nasdaq, PCC and the VIX. I hope you've enjoyed it. If you're new to the channel and you have liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, a huge thank you to my Patreon subscribers. Your support is greatly appreciated. If you're interested in becoming a Patreon, head over to the Patreon page and have a read of the tiers. If there's anything you like, feel free to sign up. There is a link in the description box below. And if you're not following me on Twitter yet, also there's a link to my Twitter feed in the description. In the description box below. It's quite a mouthful getting all of that out in a few seconds. Alright guys, take care of yourselves and I'll be back with you later in the week. All the best. Bye bye.